2021? No, she joined.
Awesome. Let's left-hand shake.
That's Summit Hill.
It's like using his name.
Yeah. Oh, fantastic.
We are live on YouTube.
Oh, okay.
Straight up.
All right. We doing this? Yeah, you guys want to get going?
Yes, please.
Yes, please.
All right, there's something right there. I'll put you in there.
Okay. You guys ready?
Yes.
Thank you. All right, so there's a couple of different titles for this presentation. I originally wanted to call it Wealth Building Order of Operations for Realtors, but that was way too cumbersome. And so we came up with Realtor Finance 101. So the thing about building wealth is that there's no class in college for it. They don't teach it to you at Hondros or when you go to realtor school. And I think a lot of times this concept of building wealth is kind of not documented, not really spoken about. And so I wrote this class really to just kind of like cut the crap and just basically explain how to think about money, how to think about wealth, and how to build wealth specifically as a real estate agent. So that's the point of this class. So before I go into it, a couple disclaimers. I have no acronyms after my name. I'm not an MBA or a CFP or a CFA or an accountant. I have zero credibility for teaching this class. So like, you can't sue me if you follow any of this advice that doesn't work out for you. And before you pursue any, in all seriousness, if you start making any financial moves, make sure you're working with professionals and run it through their filters, since I am not one. Okay, great. So the first thing about wealth, like everything else in life, is it all kind of starts from the neck up. So I want to just do a little bit of mindset check before we start talking about wealth building ideas. So happiness is ultimately your choice. And it's determined by how you define happiness and if you can achieve that happiness that you've defined. So I just want to desegregate, I want to decouple happiness from money. Let me just do that first, because if you're not clear on what makes you happy, you're not clear about what role money plays in your life, it's really easy to confuse them. And that can lead to a lot of unhappiness, right? Your finances are the engine that drive the pursuit of your happiness. So if you know what makes you happy, but you don't have any money and you know you make you happy, that's not going to work out for you. So I just want to be clear on the difference between those two things. Does that make sense? Yes, Peter?
Yes.
Okay, great. So, and ultimately, our finances are our own individual responsibility. Okay, great. So here's an exercise I want you guys to start. And I believe this is it from that, Jen? Yeah, I think this is the first stage. So here's the thing. What does it mean to have enough? Because I think enough means different things to different people. And I would argue that we've never actually slowed down enough to ask ourselves, what is enough for me? In terms of stuff, in terms of finances, in terms of confidence in my finances. Because if we don't know what enough is, what's the default answer if I say, right, how much money do you need? What is that number? If you don't know the number, the answer is always more. What's the problem with saying I need more? It's never enough, which puts you in a place of scarcity. And when you're operating from a place of scarcity in your brain, that really makes for some bad decisions and some bad thinking along the way. Who has ever felt stress of not having enough? Yeah, it's a horrible freaking feeling, especially when you're at 100% commission. The anxiety of waking up and not having a paycheck coming your way and feeling like you don't have enough is a really terrible cocktail. It's like cortisol dump city. Terrible. So it's really important that we understand what enough means so that we can be aware of the progress we're making. Anyone ever read The Gap in the Gain? Yeah. What's the main point of The Gap in the Gain, Judy? Oh.
There's always, you have to know what you're after, because there's always going to be that valley.
Yeah, basically the gap in the gain is saying like, look, we all know if we know what our number is, and you focus up and you wake up every day and focus on the gap between you and that number, that's a really bad mindset to put yourself in every day. But if you celebrate also the distance that you close to that goal, it puts you in a better mindset, right? If you know what the goal is, if you know what your enough number is, and you're moving towards that, it makes for a much healthier way to go, much healthier energy and a better way to attack your day. Yeah? Okay. So the funny thing is that if you feel like the answer is I need more, the funny thing is it will actually push you further from wealth building, because a lot of times more shows up as I need more shit, right? If you don't know what enough is, and you don't know what wealth means to you, then sometimes you just kind of substitute buying stuff because it makes you feel wealthier, it makes you feel successful. And we happen to live in the most powerful consumer culture on the planet. Nobody knows how to market shit to consumers better than American corporations, right? And so we're constantly feeling the pressure to acquire stuff because we've been programmed that way. And if you don't know what your enough number is, and you don't know where you are in relation to it, you're going to lose that battle because American corporations are stronger, more powerful, and more advanced than we are, right? It's just a statement of fact. So knowing your enough number kind of becomes your shield from all the doodads out there for sale. Okay. So there's a bunch of different ways to define wealth. This is Gary Keller's definition. A wealthy person is someone whose passive income exceeds the expense of their lifestyle. What is passive income?
Something you don't work for.
Yeah, it's unearned income. Income that comes to you whether you decide to do work or not. That's called winning in the game of life. So passive income is unearned income. It could be money from businesses, it could be from stocks or bonds, right, like dividends or coupons. You could be doing lending, right? Hard money lending is a great way to generate passive income. Or our personal favorite, which is what? Real estate. That's exactly right. I'm going to give an example later on. Okay, so here's what I want you guys to do. The first thing I want you to do is figure out what is your enough number. So if you think about paying your mortgage or your rent and going out to dinner once or twice a month or once or twice a week or whatever with your friends or with your significant other, your car payment, your insurance, groceries, all that stuff, if you figured it out, what would it cost you every month just to like cover your bases, however you live your lifestyle? What does that cost you every month? Now, you're not going to know this right now, but the easiest way to do this is to look at the past 6 months of bank statements and add it all up and divide by 12, all the money out. And that's probably going to be what it costs to live your lifestyle right now. So who knows that number right now? You do? 1, 2-ish, 3, 4, 5, 6, 7, 8. Okay, 9, 10. So about a third of the room, you guys know what your monthly number is. If you don't, the first thing we got to figure out is how much does it cost us to live? Because how are we going to know how much we need to save in addition to that if we don't know what it costs to live, right? So that's your enough number. By the way, you got to divide that by, well, I'll get to that. I don't want to overwhelm you. So, and then I would say, Nobody here, I'm assuming, is planning on relying on Social Security when you retire?
Not a thing.
Yeah, it may not even exist by the time some of us retire. Okay, so it's up to us, yeah? There's no corporate 401k program for any of us in this room, so it's up to us. So if it's up to us, how much money do you want to be saving to do your wealth building investments, in addition to whatever it costs you to live your life? So for example, if you want to put away, let's say $50,000 a year into the stock market, well, that would be roughly $4,000 a month, right? So if your lifestyle is $10,000 and you want to put $4,000 a month into the stock market every month, well, that would be $14,000, right? That would be the number that you would put in. That would be the number that you would want to make sure you're netting after taxes every single month, so you could start putting away $50,000 a year towards retirement. Does this make sense as a concept?
Yes.
We can't do that now, but please, 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 slow down, book an appointment with yourself, maybe this weekend or on Friday afternoon, because no one does anything on Friday afternoon. So like, do that exercise on Friday afternoon and figure out, what does it cost me to live my life? If there's any additional things that you would like in your lifestyle, add those in, but more importantly, add in, how much money do I want to be putting towards wealth building every single month? Les, we're a little bit older, so our number probably needs to be a little bit higher than Chase's, right?
I'm offended by that question.
Okay, good? On this slide? Yes?
Yes.
Okay. So before we get into like specifics, I want to just give two ideas around money. The first is, and if you think about, we'll look at it from a business perspective. There are two critical reports that every business has. The first one is the income statement, how much money is coming in, how much money is going out, do we have a profit at the end of it? And the second is the balance sheet. Sorry. So in income, money in, money out. In personal expenses, we call that our budget, right? How much money do we net from our businesses? How much money do we spend on our lifestyle, and how much money is left over? Yes?
Yes.
And then there's balance sheet. So in a balance sheet, it just tells you how much the business is worth. You take all the business's assets and you subtract from it all the money that the business owes, and whatever's left over is what the business is worth. We call that equity, right? Just like a house. You got the house's value, you subtract the debt, what's left over is equity. Well, it's the same thing when we talk about a net worth or a personal financial statement. This is one of the ways that we track wealth. Make sense?
Yeah.
So your net worth is just all the stuff you own less all the stuff that you owe. So here's what a personal financial statement would look like. You put your assets on one side, and then you put your liabilities, your debts on the other. So let's look at this realtor. Realtor has $2,500 in cash, and she has $25,000 in savings accounts. And she's got $5,000 in a checking account, okay? She has $75,000 in a taxable investment account, as well as $150,000 in her retirement account. She owns a house worth $350,000, and she owns a car worth $45,000. Okay, so you add all that up, it's about $650,000 in assets. Does this make sense?
Mhm.
Okay. The problem is she owes some money also, right? She got $7,000 on her credit card. She owes $35,000 on that $45,000 car. She got a mortgage on that $350,000 house, and she's got some debt because she went to college. So she owes $372,000. So we subtract what she owes from what she owns, and the difference is that she has a net worth of about $280,000. This makes sense as a concept?
Mhm.
Makes sense. But it's before you get the income ratio.
Well, there's no income on here. This is not debt to income. This is assets versus liabilities. So her net worth is about $280,000. That's actually higher than the average net worth in this country, believe it or not, for somebody in their 40s. So there are multiple ways to track wealth. The traditional way of tracking wealth is looking at your personal financial statement, right? And seeing how much you're worth. It's not the only measurement of wealth. I'm not sure it's the most important measure of wealth, but it is a measurement of wealth that we should all track. So has a personal financial statement or a net worth statement that they update regularly? 1, 2, 3, 4, 5, 6, 7. So, you ever heard the expression, what you measure improves? So if you would like to build your wealth, you probably should track it. Because if you're looking at it once a month or once a quarter, it just keeps you in that mindset of I'm growing wealth, not I'm going out and buying shit. So if there were a second thing to take away from this, I would strongly encourage you to do a personal financial statement and just see where you show up. You may be negative. You may have more debt than you have assets. And if you do, that's okay, because now you know that. And once you know it, you've got your arms around it, now you can change that. Does this make sense as a concept? When did I start doing this? I think I started tracking my personal financial, maybe in like 2012, I started doing this. And ever since then, I update it once a month. And it's kind of satisfying watching the needle move. It doesn't move as fast as like getting another deal together, but it does move the needle. And then it kind of becomes like, well, how do I push that a little faster, right? Okay, the second thing, oops. Oh, I didn't talk about budget. If you don't know how much you spend a month, we also need to know that number if we're going to build wealth. So again, just take 6 or 12 months of bank statements, figure out all the money that went out, subtract from that your quarterly taxes, and then divide that by 12. That's your number. You don't have to figure out what every little thing is you spend money on. You just need a number that you can work off of. Cool? Yeah. All right. So 2 more concepts. This is from a book called Stop Acting Rich, which I love. There's 2 kinds of wealthy people or affluent people. The first ones are income statement affluent. Income statement affluent people make a lot of money every month, right? They've got strong income statements, lots of money coming in. Balance sheet affluent are people whose affluence is generated from the assets that they own. That is to say, the assets produce income, unearned income, which drives their affluence. Which one do you, in theory, want to be on? Balance sheet. So you all know I used to live in Indian Hill, right? And I had some very fancy friends. And my wife and I used to scratch our heads like, what the hell are we doing wrong? Like, these people are just like killing it. We were like the po folk of Indian Hill. And we had these friends who shall remain nameless. And like they bought new cars for their kids, and they belonged to 2 country clubs and all this stuff. And she was an executive at a company. Got to be careful here. It's a small town. Yeah.
You all know.
Yeah. She was the breadwinner, and they just lived high on the hog, and we should scratch our head like, God, we suck. And she lost her job. And in less than 30 days, they had sold one of their kids' cars, and they had quit both their country clubs because they couldn't carry the payments. They couldn't carry the payments for 30 days. They were poor. They just happened to have a big income that they blew every single month. That's called being poor. Income statement affluence sucks. It's where we all start, but we want to get out of that as quickly as we can. So this is from Rich Dad, Poor Dad. It's a little fuzzy because I had to steal it off of an internet page. If you think about it, there are 3 different, if you think of the three sort of so-called classes, you got low income, middle class, and then wealthy. So on the top, we have the income statement, right? Money in and money out. On the bottom, we have balance sheet, their assets and liabilities. So the top one would be like the budget, and then the bottom one would be like the personal financial statement, the net worth statement, right? Unfortunately, for those that are low income, any money that you make goes straight towards paying the fundamental expenses of life, right? Sort of like subsistence living. Here's where it gets interesting. Middle class, you've got your job. Maybe you're a knowledge worker, maybe you're white collar, and you are making a little bit more money than you need to drive your daily expenses. And so what do? You leverage up and buy a fancy car, right? And so what you do is you use your additional income over your baseline needs to start financing a lifestyle instead of acquiring assets that finance the lifestyle. Yeah? This is the middle class trap. This is where corporate America comes to prey on our civilians. And we're all victims of it to some extent. I've got stuff I don't need because of this. So we leverage up, we take on school loans, credit card debt, mortgages. Well, mortgages are okay if it's for your personal home. But you can over mortgage, right? You buy a bigger house than you really should be buying. And so all of your disposable income actually goes to covering the additional debt you've incurred to live a fancy lifestyle. This is the trap. Realtors get caught in this trap all the time. Yes? Whereas the wealthy, they take their income and they acquire what?
Assets.
Assets. The assets then generate passive, unearned income in the form of rental income, dividends, interest, royalties. Yeah? So this is not easy to do. But this is Gary's definition of wealth. When the assets that you own are worth or generate more unearned income than the expense of your lifestyle. That's considered wealthy. Who's read Scott Galloway? Nobody. Okay. So Scott Galloway is he's famous for writing the book The Algebra of Wealth, Before, if you've heard of that one. Anyway, he talks about his friends who are hotshot Wall Street guys, finance bros, and how they have these, like 6, sometimes 7-figure incomes that are, they've got like 2 ex-wives, so they've got all kinds of alimony and child payments and houses for all of them and all this crap, and they're really poor because if you took away their income, they'd be broke. And he talks about how his mother lives on $40,000 a year and gets $50,000 in Social Security. Who's wealthy? His mom is wealthy. She lives off of unearned income. And that's ultimately Gary's definition of wealth. I think there's some truth to that because what happens if all of your money is, if all of your assets are illiquid items that don't generate passive income, like let's say artwork or gold or cash or boats, like that all shows up on a personal financial statement as wealth. But now you don't have any cash flow, right? We call that being cash poor. Who's been cash poor before? Sucks. Okay, so is this the next? Yeah. So here's an important idea because we think that wealthy people make a lot of money, right? Wealth is actually not determined by the size of your income. And this is a really important statement. It's actually determined by the size of your savings. Why is that?
Because your savings buy your assets.
Hell yeah, Chase. I love the confidence on that too, right? That was amazing.
Your income can also go back.
Your income can also go away, yes. But a lot of people think, I've got to make lots and lots of money to get wealthy. Okay, yes, but actually you really need to save lots and lots of money. And what happens is we start making more money and we start buying dumb things and we're still netting the same amount of savings. Because your savings is used to buy assets, right? So your income minus your expenses is your savings or your capital. Okay, ready? Everybody good on mindset? Okay. So what do we need to do here? We need to grow income and minimize our expenses. How do you grow your income? I guess I just gave it away.
Somewhere else.
Sell more houses. How do you do that? Yeah, you spend more time in your 20%. Who is this new for? Okay, great. So we're still not doing it. All right. The other thing we think we have to grow our income to grow savings, and that is true. But actually, the easiest way to have more capital to buy more assets is through cutting costs, personal expenses. A lot of us, I think, have started to incur a bunch of personal expenses we really don't need. that are really kind of taking away our opportunity to build wealth. This is, I think, the easiest step is cutting expenses that you don't need. A lot of times they call the difference between your income and your expenses disposable income. Why is that an evil phrase?
Because then it makes like you can just sell it, buy it, anything you want.
Yeah, it's disposable. I've covered my costs. That has got to have been come up with by corporate America, right? What an evil phrase that is. What should we be thinking about that as? Capital.
Yeah.
Yeah, like my war chest. Let's go out and take some territory. So I would call it savings, capital, investable income. I like capital the most because that's really what it is. You're creating capital to acquire assets. All right, what else here? So we talked about wealth building is done by savings. The other thing I would say is any debt that's greater than 5% interest, I would probably pay off. Why is that? It's outpacing inflation, yes. And if you really want to get clever, can you typically get higher than a 5% return in the markets? Yeah, and I'm not advocating for arbitrage. Like I think that's super risky. I'm financially very conservative. But any debt that's greater than 5%, you should pay down. Anything below that is really manageable because you can get a better return on your money in the markets or wherever you choose to invest it. Make sense?
Is there an example you can use?
Yeah, like if your credit card debt is 20%, I'd pay that down, man. Before I went and bought stocks that historically return somewhere between 8 and 12%, I would pay down my credit card bill that's charging me 19%. However, if I got my mortgage sometime before 3 years ago, and it's at 4%, I wouldn't race to pay that down, right? Because I can get a better return on my money somewhere else. Great question, Brett.
Would you feel that way with the rental property as well?
So we're going to get into rental properties in a minute. Can we come back to that? Okay. So what's our single largest expense personally? Our taxes. It'll be our taxes. When you factor in state and local, it's taxes. What's that? Your wife is your biggest expense. Yeah. Here, well, this is live on YouTube, Brandon.
But I love my wife.
Worth every penny. Okay, so now let's start talking about actual building blocks to building wealth. First thing is you need some cash in the bank. Has anyone ever not had a closing on the horizon and didn't have any cash in the bank? How'd that feel?
Wonderful.
Yeah, it's terrible. And so the very first thing we need to do is have some cash in the bank. You can sleep at night when you've got cash in the bank. So Dave Ramsey would argue 6 months of personal expenses, cash in the bank. That's not for everybody. I would say at least 3. I keep 8 to 9 months because I'm financially very conservative and I just sleep better at night when I know I've got money in the bank. But this is one of the first steps you want to do is make sure you've got money in the bank. Especially as realtors. Has anyone gone a month or 2 without a closing? Sure. And so you got to have some money in the bank. And then if you dip into that money, you got to do what?
Replace it.
Yeah, replace it. That's exactly right. And then, sorry guys, like the first step to wealth building is actually playing defense first. So what does that mean? That means health insurance first and foremost. Please tell me you have health insurance. Okay.
I'm on my wife, so.
Okay. All right. I winged it for like 2 years, and that was the dumbest thing I ever did because I didn't have health. I was young, but that was still stupid. So no health, no wealth. A friend of mine was saying the other day, you've got 100 problems until you don't have your health, and then you only have one.
Yep.
Yeah. And so having health insurance is critical, and that's all I have to say about that. This is This is one that we all ignore as realtors. We don't buy disability insurance. And the thing about disability insurance is that it's cheap. And the other thing about disability insurance is that if you are disabled, you are an army of one, Chad. You have nobody employing you, have nobody covering your costs for you if you're disabled. So what if you're hit in an accident, you can't function as a realtor for 90 days? What's going to happen to your income? What happens if you are like permanently handicapped in some capacity? You can't be a real estate agent. What are you going to do then? So this is defense. I resent it every time I write this check every single year. But I also know that if I ever am disabled, my family is not fucked.
Similar to life insurance.
Different.
Different.
Disability insurance is, let's say you get hit by a car and you can't operate a vehicle anymore. Well, you can't shut houses, right? So how are you gonna make your money? Disability insurance will pay you a set premium every single month, oftentimes with an inflation rider, so that it replaces the income that you've lost from being disabled.
So like from Aflac, like something like
Yeah,
that?
Aflac would be
Okay.
disability insurance.
That's what I thought.
That's exactly right. Everybody wants to skip this one because it costs money and it's not sexy. And if you don't use it, it's not worth anything. But it's worth having because it protects you and your family, frankly. If you're responsible for somebody else financially and you don't have disability insurance, you're probably being irresponsible. Okay. Just buy enough auto insurance to cover your car and the other person's car. And then this is dirt cheap. Umbrella insurance is like super dirt cheap. It's also a misnomer. What does umbrella insurance actually mean? What is it? Covers what?
Covers anything that your insurance doesn't cover.
It covers your property and casualty above the limit set by your property and casualty policy. So if someone slips and falls at your house and they sue you for $5 million and your home insurance is $2 million, the gap, that $3 million gap would be up to you to pay. Umbrella insurance is an additional layer of insurance that you can purchase to cover you where your standard property and casualty insurance policies stop. Make sense?
Mhm.
So here's the deal. If you are worth anything, you need umbrella insurance beyond. If what you are worth is worth more than your auto or your home insurance policies, you need umbrella insurance to cover the difference. Does that make sense as a concept?
Can you say that again?
Yeah. If you are worth more than the coverage on your auto policy or your home insurance policy, you should have umbrella insurance to cover the difference. It's cheap
Or
too.
you'll have to pay it for something catastrophic.
Yeah, for sure. And then finally, I think if you don't have one, get a will in place, right? It doesn't cost a lot. You can probably download one from the internet and just fill it out and sign it in front of the notary, and then that's done. But you want to make sure that the money is going where you want it to go if you pass, and it's being spent the way you want to spend. And then to your point, Brandon, life insurance. So there's different philosophies on how much life insurance is enough. Did you have a thought, or are you just holding your pen like this?
Oh, I'm just throwing my
Oh,
pen,
okay.
sorry.
Usually 10 times your current income.
10 times your current income. Okay. So 10 times your current income. I think it also depends on how much liability you have and whether you do whole or life. So if your intention is to acquire assets that ultimately pay for your lifestyle, I probably wouldn't buy whole life insurance. I would just buy term to cover me until my assets cover my lifestyle. Now, if you don't necessarily believe or you're not convicted that that's going to be the case, you may want to do whole life. The policies that I have in place are enough that if I die, are debts that are outstanding, which are all healthy real estate debts, but all of those debts are paid off. So that Lynn has no financial obligations to anybody, plus our passive income, and she's set. I used to keep life insurance to pay for my kid's college also if I died. So if he's graduating in 2 months, so I can
We still got one.
peel that one off. So, okay. And then the last piece of sort of fundamentals here would be entity formation. We're going to talk about entity formation a little bit later. But one of the things that you want to do is create a limited liability company to hold your assets. Anything that generates passive income should sit in an LLC. And I'll explain why in a little bit. Okay? Keep going.
Yep.
Okay. In addition to that, let me just I have lost so much money because none of this stuff was taught to me. I've invested in failed Keller Williams franchises. I've invested in failed real estate syndications. I've missed hundreds of thousands of dollars of tax write-offs. I've missed hundreds of thousands of dollars in retirement accounts. And I really wish someone had just sat me down and explained how this stuff works. And one of the places that I missed was as soon as I started making money, I got cocked. And I stopped maximizing my retirement accounts. So one of the very first things that you should do is put one together. So what's a retirement account? Give me what's a retirement account? Yep, Roth IRA, SEP IRA. What else? 401k if your spouse works. Although there are now personal 401ks. So these are kind of the typical ones. So you've got your IRA or what we call a SEP, self-employed IRA. That's what we should do, generally speaking. Why is that the best one for a realtor? Yes. Yeah, you can put up to 25% of your income in a SEP IRA. That's a massive tax savings, right? If you're making $150,000, no? Is there a limit to it? Give me a face like I'm wrong.
No.
Oh.
Oh, you're looking at me?
Yeah. Yeah. So let's just say use simple numbers. If you make $100,000 a year, let's use a bit more. Let's say making $120,000 a year. You can put away about $40,000 of that into a SEP IRA. $40,000 pre-tax. So if you're a 35% tax bracket, that means you're saving about $13,000 in tax savings that you're keeping instead of going to Uncle Sam. That's legit. Multiply that over 10 years. What does that look like? $130,000. That's you're saving tax-free and it's growing tax-free. HSA. What's the point of an HSA? This is a big deal. Yeah, and later in life you can draw against your HSA. It grows tax-free, and it's tax deductible. And then later in life you can use it to cover health care. Here's what's really exciting. 2 years ago they made a change. Once you clear, I think, age 65, you can actually draw down on your HSA for non-health care expenses. So it becomes another vehicle that you can use for retirement funding. And I think the HSA limit now is what, 8,000? No, it's, oh, sorry, I'm thinking for couples, 36. I think for couples it's like $7,500 or $8,000. So it's $80,000 over 10 years, and then you factor in the growth, it starts to become some real money that you can use after retirement.
That's a willable asset. So
HSA is willable.
yes.
I love that. 40 grand for SEP IRA? Oh, for HSA. So it's 8,800 for a couple then? Yeah, I mean, that's legit. That's almost $9,000. 8,750. So you get penalized to be married.
Yeah.
$50 marriage tax. All right. What's next? Once you've got some retirement savings in place, then we want to start, once you've done these defensive things, now we can start building out our war chest. And when I say war chest, I mean an account where we're storing capital so that we can go and acquire assets and begin investing. So if you're looking to grow your war chest faster, flipping a house, I guess, is going to get you more capital faster if you want to deploy more capital faster. I say that, but I don't actually believe it. Because I think the time that you spend flipping a house would be better spent selling another house. I think it requires less time, there's less distraction, less energy, and it's more in your wheelhouse. Now, I know agents that flip literally dozens of houses every year, but by and large, for most of us, I would say just double down on your lead gen and sell more houses. Because there's a lot, well, I'll get into that later. And then I think if we really want to build wealth, there's two places that we should be putting our capital. The first one is real estate because we know the market. And then the second one I would say is investing in businesses. That could be your business or it could be investing in another business. My best returns have always been either investing in myself, the people I work with, or in businesses. The problem is that investing in businesses are way more risky than investing in real estate. So if you want kind of set and forget it, quiet returns, real estate is way better than business. And critical, obviously, invest in what you know. That's what Warren Buffett would tell us. He's a pretty smart guy. So let's visualize this real quick. You start here at the top, and we determine what is our net worth. I would do this like this weekend or Friday afternoon. What am I actually worth? What am I working with? What's my benchmark? And then let's determine your weekly, or I would say monthly, cash flow. Don't obsess about it. Figure out the number from your bank statements and let's get going. Build your reserves. If you don't have cash in the bank, like there's nothing else to do except get some money in the bank. Work on the boring like defensive stuff first. And then let's go figure out how do we fund our enough number through passive income. Buying assets that generate passive income that start covering some of our, what does it just cost me to live? And then we start financing the various devices we're going to use to generate that income. And over time, those things grow in value, which increases our what? Net worth. And then we get to skip all of these and just go like this. And that's when it gets really fun. Questions about that? Okay. Let's talk about taxes, because our single largest expenses are spouse or our taxes. Brent's not here.
She read him and told you.
Yeah, she texted, you better get home right now. All right, so taxes are number one expense. What are some of the write-offs we use as realtors on our taxes? Cell phone bill.
Office.
Office, home office, you mean? Yep,
Education.
100% home office. What else?
Tuition fees.
Education.
Tuition fees, education, transportation, mileage, yep. Meals. Coaching, if you're hiring a coach. Your MLS dues, realtor dues. Health insurance can be written off, right? Your HSA is kind of a write-off. Your devices, your cell phone itself, your computer, all that stuff can be
Home office.
home office, yep. So these are kind of the typical strategies for realtors, right? But your real enemy in the world of taxes is the self-employment tax. This is onerous and insulting and maddening. You may not know this, but the federal government charges you 15.5% of your income for the privilege of working for yourself. You got your federal tax, you have your state tax, you have your local tax, and we get to pay our own self-employment tax. For those of you who have spouses or significant others that are employed, they pay like 7.5% income tax, and the corporation, the person hiring them, pays the other roughly 7.5% of income tax. But since nobody's hiring us as an employee, we get to pay all of it ourselves. How's that feel? Okay, hopefully that pisses you off. So, how do you protect yourself from that? The way you do that is by forming an S corp. Now I know some of you guys already know this, so just work with me here. You form an S corp. An S corp is a form of LLC that is designed for organizations, for companies that have employees. And it removes the self-employment tax, not completely. I'll show you how this works in a second, but it dials down significantly the amount of your income that you're paying a self-employment tax on. So you'll also be able to participate in what's called the qualified business income benefit, or the 199A. You may have heard your accountant refer to it as. So let me show you how this works. There's two kinds of income and there's two kinds of entities that we care about. Earned income is what we think about every day. I got a commission for selling a house. Peter's got a consulting project, or consulting client. You sell something on eBay or whatever. You sell your service. And if you did a deal in the short term in real estate, like you wholesaled something or you flipped a house that was less than 12 months, these are all earned income in the eyes of the IRS, right? You're basically, ultimately, you're exchanging your time for dollars. Does everybody get this? Yes?
Yes.
The other is unearned income or passive income. Dividends, interests, royalties, cash flow from investment properties, a capital gain from the sale of property that you own more than 12 months. These are all unearned income, tax at unearned income levels. All right, I can barely keep Chad awake here. I'll go faster for Chad.
You're good. Sorry.
So let's look at how does this work? Let's just say you are working on your own, right? And let's say you make $130,000 in gross commission income. And you've got $20,000 in expenses, you know, your cap, royalty, maybe you're buying some Zillow leads, whatever that looks like, and you net $110,000 on your business. Everybody with me? In this scenario, at a 15.3% tax rate, you're paying $16,830 in self-employment tax. Remember, there's the privilege to be self-employed. Who's pissed?
Me?
Good. Yeah. Great. So this is what's really interesting. When you set up an S Corp LLC, an S Corp specifically, you hire yourself as an employee. So now let's look at the same scenario. You bring in $130,000 of income, you got your $20,000 expenses to run your business, and you pay yourself a $40,000 salary. That means the company, because you're an employee of the company has now made a $70,000 profit. With me? Profit is not earned income. So profit is not subjected to a self-employment tax. So in this scenario, I'm paying taxes, self-employment taxes on my $40,000 salary, which means I'm paying $6,000 in self-employment tax instead of $16,000. That's $10,000 in self-employment tax savings.
You scroll back.
Yes, sir. Yeah, it's maddening. And whose accountant hasn't told you this and you've been working with an accountant? It's fucking crazy. Pardon my French. It makes me just, what's that?
No, I say surprised they didn't tell her because I feel like that's like.
It's their fundamental role.
Right. Yeah.
But accountants are overworked and they don't give a shit. They don't make more money if you do this. So like, I get it. That whole industry is struggling. Well, that's true. Yeah, that's true. They could charge you a business return. Yeah. Yep, that's true. Good. Has the anger level?
Yes.
Would you like to take a picture of this one too? Okay. Yeah. More pain. Okay. So remember, you still have to pay self-employment on your tax on your salary, but you don't because now you're taking dividends, distributions that are profit and not earned income. Everybody good on that concept? This one?
No, that one. The Maggie one.
The maddening one. Yeah. Now, Donna has a great point. This costs a little bit of money. You've got to form an entity. You're going to have to hire someone to do payroll, and you're going to have an additional tax return that you have to file every year. But if a tax return is like $1,500, maybe $2,000 plus or minus to do that return, you have to pay an attorney to draft up an operating agreement. So there's a little bit. You can even probably download an operating agreement online, frankly. So if you can save more than $2,000 a year in self-employment tax, you ought to do this. Yeah.
Yes.
I think it's somewhere between, it's probably between $80,000 and $100,000
Stay as an LLC.
until you hit that number.
Well, yes, I've hit that, but you just told me to stay as an LLC, do not go to S Corp yet.
Okay.
I can't remember why you said a lot of words. And I blanked out, but basically you just said stay where I was, and I was like, good enough for me right now.
Yeah.
My husband has multiple S Corps and 4 or 5 LLCs, and so I try to just back off.
Well, your husband, well, okay, I'm not gonna get individual. So her accountant says don't do it yet. I think $100,000 conservatively, that's a good threshold.
Yeah, that's what my account said.
$100,000 per person.
Yeah.
So
Yeah,
since
right, because
Sarah
you-
and I
yes.
said, okay, now you gotta switch to an S corp.
You're saying
So let's make it a certain threshold.
that you can pay yourself $100,000, right?
You could if you want to, and this is why you want to talk to an accountant. So in this salary, in this example, I picked $40,000 because when I wrote this is sad. When I wrote this PowerPoint, does anyone understand this word? When I did these slides, I Googled what is the median realtor income in Ohio? It's 40 grand. Yes.
It's probably worse than that now. Yeah,
Right.
there's a lot that make $0.
Median, not average, median. Because in this scenario, you want to pay as little salary as possible because I'm getting blown up, guys, because that's what's being taxed, self-employment tax. Now, if I'm new to this independent contractor game and I've got to go borrow money in the next 2 years, I probably should pay myself a higher salary so it's easier to qualify for a loan. This is why you want to talk to your accountant or your financial planner or whatever, because there's games to play.
Yeah, you don't want to write it all off if you're trying to buy a house.
Right, right. Or buy assets, right. That being said, if you've been doing this for 2 years or longer, then they don't care. So if you have 2 full tax returns, then you can throttle back. Okay, questions about this?
It's probably a dumb question, but what happens to the 70K? Where does that money go?
The profit?
Yeah,
That goes to you in the form of a distribution.
instead of an income.
Correct.
Okay, I just look at them like that. It just disappears.
No.
I know that's not true.
The
but in my
government's
head, I'm
cut
like,
disappears, but we keep it.
Okay, so you pay it as a different, not as a salary, but
You're
like
taking
something
it
if
as
you
a
got like tax
distribution.
returns or not tax, I'm sorry, stocks, payouts,
Yes,
that type of
you're
thing.
still taxed on it, but it's not subject to the self-employment tax.
Yes. Yeah. Okay. I just I
Great.
couldn't get that last.
Great
one.
qualification. Great question. Okay, good. Question about the S corp.
Isn't a single member LLC has the same attributes as an S corp?
Les's question is, does a single member LLC have the same attributes as an S corp? I don't know because I'm not a legal professional that can answer that question.
But from your experience,
From my experience, every accountant I've ever talked to said if you're hiring yourself as an employee, it needs to be an S corp. I believe this is why, is because S corps only pay self-employment tax on employee income. Okay.
Just like a regular corporation.
Yeah, just like a regular corporation. So this is just the two of them combined for you guys to be furious over. Good on this? Oh yeah, take a photo. Yep. Photo's good? Okay. So now, what is now permanent, the QBI benefit. So when Trump was in office the first time and he passed a tax bill, he introduced this concept of the 199A or the qualified business, I think incentive. And the idea was this. Oh, during the 2017 Tax Cuts and Jobs Act. The idea is this: the first 20% of a business, the first 20% of profits of a business is no longer taxed. So if your company made $100,000, the first $20,000 is not taxed. If you're operating as a business, again, I'm not an accountant, I'm pretty sure you have to form an LLC and take the money through an LLC. I may be wrong on that one. But your accountant, make sure your accountant, look at your tax return from last year before you file this year, and make sure that your accountant took the QBI, or sometimes it's called a 199A on your tax return. Make sure you're getting that tax break. 20% of your income is a big deal. If you made $100,000, that would be 20 grand. Well, if you're saving 35% in taxes, that's about $6,500 that you can save. The reason why they're doing this is because they want businesses, Trump wants businesses, incentivizes people to form businesses because they hire people and they drive the economy. So this is a benefit. And you guys technically are businesses. We all are, if you file the correct way. Oh, and the great news is when what's it called? The big, huge, beautiful bill? Big, beautiful bill. When that was passed, it made the QBI permanent because it was just a 5-year thing initially, but now it's permanent, which is great. All right. So the tax code is written to encourage two kinds of behaviors. The first is to encourage and foster more business development and hiring, and the second one is for people to own real estate. The government wants you to own real estate, and the government wants you to form a business and hire people. Those are the things that drive a healthy economy more than anything else by like a lot. So I think I just said this, yeah. So these two forms of ownership, owning a business, owning real estate, these are the two most powerful vehicles to maximize tax benefits of the tax code. And if you're missing out on those two things, you're missing out on a ton, right? So this is like the secret sauce for realtors. See, yeah, let me tell you about this. This is crazy. So for most people that own real estate, if they take a loss on their real estate, they can apply that loss against gains, correct? Yes?
Yes.
But when it's a passive loss, they can only apply that passive loss against passive gains. So doctors and attorneys love real estate because they have distributions coming in from their stocks and their bonds and whatever else. Well, that's passive. So they use the paper loss from real estate to not pay taxes on their passive gains from their assets. Does that make sense? But it's limited to passive gains. But for people who are full-time real estate professionals, you can take passive losses from real estate and apply it against your earned income. That's a really, really big deal. You want me to say that again?
Yes.
If you're in real estate and you take passive losses from real estate, you can apply it against your earned income from real estate. So for example, let's say I have on paper, and we'll get into what I mean when I say that in a second. Let's say I have a $25,000 loss on a piece of real estate. Because I'm in real estate, I'm a full-time real estate professional, I can take that $25,000 loss and apply it against my earned $100,000 income. So now I'm only taxed on $25,000 income. You all get that?
75.
Yeah.
What did I say?
25.
25.
So you're
I'd be taxed on my $75,000. Thank you. I'm only taxed on my $75,000 income. And a 35% tax rate, that's $7,000 in savings. It's a big deal. Multiply that times 10 years. Like, when none of this is going to change your life immediately, but when you do all of these things and stack it up year over year, it really starts to move the needle.
Now, when you say passive loss, for example, you're talking about depreciation of the property.
Yeah.
Using that to apply against your
Earned.
earnings.
Yes.
All right, I just want to make sure
Yeah.
I understand that.
You got it, Les.
Are you
100%.
doing the rapid depreciation?
Yeah, I'll get there in a second. So let's talk about insider trading. Let's talk about real estate. How are all the different ways that we can win with real estate? Well, here's the first one, right? Is American real estate a pretty safe bet?
Yes.
Yeah. And does it have the massive gyrations of the market or even of cryptocurrency? No. So it's pretty predictable. Can you leverage it? Can you buy more real estate for every dollar than you can stocks? Yeah. Can it cash flow? Can you force its appreciation by adding more value? When you have a tenant in there, are they paying down your principal? Yeah. Can you write off the interest against your income?
Yes.
Can you depreciate it, take additional losses on paper?
Yes.
And are there tax advantages that I just shared with you about real estate?
Yes.
This is crazy. This is actually a legal form of generating wealth. We take it for granted because we're in the industry and we talk about it all the time. But look at this. I don't know one other investment vehicle that offers this many benefits for a realtor. It's really astounding. And the best part about it is that we're licensed to be inside traders. Right? Like we got the MLS, we know immediately when something's on the market. We know better than anyone else if it's a good value. If you're smart, you're networking with your peers and you're getting access to stuff before it goes online. Like we're literally inside trading and it's legal. You can even, I remember I was in a mastermind with Gary. And he said, every time you go to a listing appointment, the first question you should be asking yourself is, do I want to buy this house? I thought, damn, that is good, right? So let's talk about how we should manage our cash flow as real estate agents. Is this okay so far?
Yes.
Yeah, okay. So you close a deal. We got GCI, right? Your broker takes a little bit and the rest of it goes to your S Corp or LLC. And your S Corp has some expenses. Maybe it's paying cap and royalty, you're buying Zillow leads, whatever. At the end of the month, your S Corp has a net income. With me? Okay. Now, we're going to need a couple bank accounts here. Your broker processes the check and it goes into a business account, your S Corp's business account, right? The first place you move money at the end of the month is into a tax savings account. Has anyone ever had a tax bill due and didn't have any cash? Besides me. Bullshit. Only 4 people are raising their hands. Yeah. So the first thing you do is you tuck away 35% of it in a tax savings account. And you only touch that once a quarter. Yes or yes?
Yes.
Okay. And then because you did your job at the end of this week on Friday afternoon or on Saturday morning, you figured out what it costs to live your life every single month. Then you fund your checking account for the next month, right? Then you start filling up your rainy day fund, 3 to 6 months of lifestyle expenses. And then whatever's left over goes into your war chest. Right? This is your capital account or your investment account. So to be clear, if we're going to do this right, we need at least 5 different checking or savings accounts. You really shouldn't commingle any of these funds with any of the other ones. What happens if you've got your tax savings and your investments and your personal all rolled up into one checking account? You overspend. You start getting cocky when you see like 50 grand in there and you're like, oh, I'm good. Right? And then the tax man comes at the end of the quarter, you don't have the money. Okay. So let's look at an example of that. Let's say that you did well, we're not price fixing. You close a sale and you gross $15,000 of income, and after your broker and your Zillow and whatever else, your business net $10,000 that month. Here's how the money would flow. First, we would put away how much? 35%. So $3,500 goes in your tax savings account. And let's say it costs you $4 grand to live. So the next $4,000 goes in your personal account. So now we have how much left? Yeah, $2,500. Let's just say you were, let's see, it's $4,000, 3 months of budget would be 12 grand. Let's say you had $10,000 in your savings account, your rainy day fund. You only need how much more to take it up to 3 months? 2 more grand, right? So how much do you have left over?
500.
Yeah. So now we just go, that $500 goes into our capital account, our war chest. Now next month, we can skip 3 because we've already filled up the personal savings account. Sorry, the rainy day fund. So we just go straight from 2 to 4. Does this make sense as a concept?
Savings account be $12,000?
Sorry, I was saying let's assume there's 10,000 in there already.
Gotcha.
Chad's like my fact checker today.
I'm not trying to be, I'm just.
I like it. I like it. Okay, does this make sense?
Yes.
It's okay if you don't have all these accounts today. But maybe on Friday afternoon, create these accounts at your bank. Yeah, link them all together online. Great. So what's the roadmap? Here's the roadmap. Number 1, buy health insurance. If you don't have health insurance, there's nothing else to talk about. And then establish those different checking accounts and savings accounts.
TCG and the.
What's that? Well, everyone should join TCG. I think that goes without saying.
I love it. I love it.
We'll be taking applications outside in the lounge.
And the recording.
I have it recorded too, so it's there forever.
I mean, listen, everything's negotiable. All right. So then we want to figure out what our personal income statement is. What is our net worth? So we can start pushing that, as well as what it costs us to live every month. If we don't know that, we're never going to generate wealth. 3 to 6 months of savings, and pay off any of that onerous debt that you've got that's going on, right? Car payment, credit card, anything that's over 5% is evil, and we should pay it off first, right? Get that toxic debt out of your life. Good? Oh yeah, there it is. So there's your balance sheet and net worth. Okay. That's the boring stuff, but this is the stuff that has to be done first. So we need to take pictures. Good, Luis? Yes, sir.
Question. Going kind of back to like anything over 5%, mentioned Ramsey. Are you in the field of thought, do you pay off your highest debt balance or do you pay off the highest APR? Because, you know, you have talked about the snowball effect where you take,
Yeah.
like, say you have $5,000, $10,000, and $50,000 and 3 of the credit card. Pay off the smallest one first.
Yeah,
Build,
get the win.
or do you go after the highest APR?
Do you guys all understand that question? You hear it over there?
I think you take the
Snowball
win.
versus avalanche.
Les is saying snowball, so pay off the small balance first. I think it also depends on like how you're wired. Like as a data logic guy, I would go after the highest APR and hammer on it.
That's kind of,
It really, like, what matters is that you're doing it. Whatever feels like the win for you, that's the way I would do it. Okay. Now, we've done the boring stuff, right? Now let's go build some wealth. Let's play offense. Oh, I guess no, just kidding. Some more defense. Disability. Start building that war chest. Get your LLC. If you're going to buy assets that generate passive income, you want that in an LLC. I actually have my stocks and bonds and stuff are actually owned in an LLC also because that generates passive income. I do that more to shield myself. Never mind. I'll get to that later. We'll have time to cover that. Do your will. And then this is figure out what your enough number is. Like how much do I need every month just to subsist? How much money do I need for the ideal lifestyle, for my art of living? And then ultimately, what's your fuck you number? Like, hey, Peter, go do that. No, man, fuck you. I don't need to. Figure out those numbers so you've got some goals. Because once you pick those numbers, like, and you start moving toward them, it's satisfying. Just as long as you don't start moving the goalpost.
You watched Gary Vee too much this weekend.
No, I had that before Gary. If we're serious about this pursuit, the next thing I would suggest is like, talk to somebody that understands money and wealth and come up with a wealth building plan. So it could just be, I'm going to put $40,000 in my SEP IRA every year. As long as you do that, I feel confident in my future. I like to buy a piece of real estate every year. That's my big wealth building plan. Like that just feels good for me. So whatever the plan is, figure it out so you can start working it. And establish your HSA. Okay, now maybe the fun stuff. Retirement accounts, and then go buy assets. That's the fun part. I also would challenge you, we were talking about this in the TCG Top Producer Mastermind today. Like, we didn't say this explicitly, but it was one of the things I was kind of hitting at is like, everyone in this room has a billable rate. You don't realize it, but when you add up all the money that you make, divide it by all the hours that you worked, that's how much your time is worth. So I might ask you, like, what are you doing that maybe isn't worth that time? Either
Cut the grass.
the first thing I got rid of when I started making some money was cutting the grass. I hated cutting the
So
grass.
do I.
Hated it. Hated it. Yeah, and it was a bad use of my time, right? Finally, my time was worth enough that I didn't have to mow the lawn anymore. So I would challenge you guys, like, what are you doing in your business that, or in your personal life that you can take that time back and apply it towards more dollar productive activities?
That's on mine.
All right. Enough about grocery shopping. Lastly, I would suggest we're on this planet for a short period of time. And so what are you going to do with your time here? What are the experiences that create meaning and purpose for you in your life so that you don't sit there rotting on your deathbed, regretting all the things you didn't do with your life? Because it's going to cost money to do those things more likely than not. And so being clear on how you want to bring purpose to your life and meaning and the experiences that you want to share with people you want to share it with helps keep you focused on the goal. Yes. Yes.
If you have, if you're at that point in your life that you have the IRAs.
Yeah.
Take some of that, but you don't have you don't have a lot in savings.
Yeah.
You know, do you take some of that out?
3 to 6 months of savings?
No, I got that.
Okay.
Sorry. Speak for a friend.
Yeah.
This friend has
Yeah.
IRAs and stuff.
Seems like a good guy.
Take money out to
Acquire assets?
fund the assets.
Great question. I am not qualified
I'm not being qualified.
for your friend. There's probably penalties if you take that retirement money out. So I don't know how good I feel about that. However, I do believe that you can move some of those money into self-directed retirement accounts. And you can acquire real estate assets, or really any asset, in a self-directed retirement account. So I would talk to your financial professional about that. I'm just going to, yeah, okay. So, great. So let me just explain what Chad was asking about earlier. Do you remember when I was talking about depreciation and taking passive losses and applying against earned income? Passive losses in real estate applying towards earned income. Yes?
Yeah.
So I'll teach you guys. Let's make sure this is dry erase. I was teaching a class in what was I? In Colorado, and it was a big room full of people, and I was deep in my zone, and I was crushing it. And I raced over the whiteboard. The first marker didn't work, and the second marker didn't work, and the third marker I pulled up, and I was just in the zone, crushing it. And then I went to wipe off what I had just written, and I had written all over the whiteboard in permanent marker. So now I always check. I think this is, Chad, can you read this? I can't. My eyes suck. Is that dry erase? Yeah. Okay. So.
You will laugh now.
I know. Well, he's been spot checking me, so I feel like I can trust him. So let me just.
It is, it's
Okay. So where do I want to go with this? So the power of depreciation is oftentimes undervalued by real estate agents. And I just want to show you guys how this works. So let's say, I'm not sure there's a lot of these out there anymore, but let's say you get investment property for $275,000. Yeah. And you've got your rents, single family, maybe in like Westwood, you could probably still buy a single family for $275 in Westwood. You've got your rent, you've got your expenses. And let's say you net, how do I want to do this? Let's say you put 25% down, right? You don't have a dryer, eraser. Let's say, I'll just keep it simple. I don't want to keep it simple. I'll keep it simple. Let's just say you rent. Yeah, let's say your passive income is $5,000 after income and expenses, right? You put 25% down the property, 20%, that's roughly like $60,000. 5% of 60 would be about 8%, if I'm doing my math right in my head. So it's like an 8% cash on cash return. That would be a good investment property in today's market, yeah?
Yeah.
Do you guys all agree with that statement?
Yes.
Okay. So you're going to get taxed on that $5,000, right? Okay. So now we depreciate it. And depreciation is just the economic loss on paper for wear and tear to an asset. So what's the depreciation schedule on residential real estate? 27 and a half years. So we would now depreciate the asset, take it as an expense. So what is 127 and a half of $275,000? Right. So we can take $10,000 of depreciation as an economic expense on our investment property. With me? Okay. So now on paper, we've lost $5,000. But we really made what? $5,000. So we actually can carry that. Let's say we made $100,000 this year. Well, we can carry that economic loss over and only get taxed on $95,000. And you're saying, Peter, who cares? $5,000, 35% is like $1,350. I'm not going to get rich on that. Okay, that's true. However, this $5,000 just came to you tax-free. That's the equivalent of making $7,500 taxable income on the property. Plus, you got to write off $5,000 against your taxes, another $1,350 in saved taxes. So we go from 7,500. Sorry, yeah, 7,500 plus another 1,350 saved is 8,850 if I'm doing my math right. So you're saving another $8,850 in this scenario. Zach.
Now that's assuming it's one asset.
Correct.
So let's say we do 2 or 3 of those, then it's no more.
100%. Yeah, thank you for clarifying that. So yeah, so if you had 3 of these things, you would show a loss of negative $15,000, but you really would have made $15,000 in passive income, and you would have gotten taxed on $15,000 less of your earned income because you're a real estate agent. Does this all make sense as a concept?
Yes.
So what Chad was asking earlier is, well, what about what's called bonus depreciation? Before we go there, let's talk about cost segregation. So in the tax code, you can take a piece of real estate and, well, let me back up. So the concept of straight line depreciation, 127 and a half of the value every year. The concept of straight line depreciation is that the house depreciates equally over each year. Now, is it true that the carpet wears out before the furnace?
Yes.
Is it true that the that the kitchen cabinets will wear out before the brick walls do?
Yes.
Yeah, so things depreciate on different timelines, right? Carpet doesn't take 27 and a half years to wear out. It takes like 3 years. Well, really 5 in the IRS. So what you can do is you can hire somebody to segregate out all the different components of that piece of real estate and put them on different depreciation schedules. So there's 5-year depreciation schedules, 10-year depreciation schedules, 15-year depreciation schedules, and then the 27 and a half year depreciation schedule. Yeah? An accountant can say, all right, well, let's chop this thing up so that you can depreciate all the stuff that depreciates in 5 years or less over 5 years. That enables you to take more depreciation earlier in the ownership of the asset. Why is that valuable? You can write up more on front.
I think it's important to point out that once you choose that sort of accounting, it doesn't stay like that. for life.
Okay.
If you start out with straight line depreciation on the property, you cannot change it later on.
But now we're talking about personal property. which
We're
you
talking
have.
about investment property.
I mean, you can write off, if you put a stove or anything to
Yes.
approve it, you could, there is.
You
a
can still write
depreciation
that
rate.
off.
Yes.
And you have the option during a year whether to do the straight line for X amount of years, whatever it's labeled for.
Yep.
Or you can take it for that year. And that would be great if you have a booming year.
Yeah.
You would rather take that. And I believe once you take it, you're right, you can't go back.
So yes, you can take more depreciation expense up front, which means you have less what? Taxable income as an active full-time real estate professional. What's the other reason why that's beneficial? What happens to the value of a dollar over time? It goes down. Why does it go down? Because of inflation. So would you rather take a dollar that you could get today? Would you rather take that dollar 27 years from now, or would you rather take it today when it's worth a lot more? Today. And so that's why investors will cost segregate a property so they can realize more of that depreciation paper loss sooner. Now, also revisited during the big, beautiful tax bill was this idea of bonus depreciation. And what it allows you to do, and they've been doing it on and off since like 2002, I believe, is let's work with bigger numbers. Let's say you buy $1 million asset. Yeah? Yeah, woohoo, great. You got maybe this is what? This is like an 8-unit somewhere maybe? So you buy or maybe a 10-unit. So you buy a 10 family and it's worth $1 million. You can cost segregate it. And generally when you cost segregate an asset, rule of thumb is about 25% of the item's value of the real property's improved value will qualify to be cost segregated. So in this case, roughly $250,000 of the asset can be cost segregated. Now, with the passing of the big, beautiful tax bill, it codified that you can take what's called bonus depreciation. And instead of splitting this out over 5-year, 10-year, and 15-year timelines, you can actually take it all in year one. So let's say you take a $250,000 loss on the property in year one because of that massive depreciation. Unless you're making more than 250 grand a year, how much money are you paying in personal taxes that year? Zero. So you should buy one house a year. You should buy a piece of real estate every single year. That's exactly right. This is why the rich get richer, and this is why real estate people never pay taxes or pay very low
Now, can
taxes.
investors do this too? They just can't do the streamline. They can't take it off their income, right?
Right, they can only take it against their earned income. That's why this is so special for us, and this is why I feel like it's a travesty more real estate agents don't buy more real estate. This should be like a holy shit, Peter. Oh man, I'm hoping that's what you guys are experiencing right now. Yeah, this is a game changer. Because if you were able to write, let's say you made $250,000 in income, and you were able to take a $250,000 write-off loss against your earned income, and you're paying zero taxes, well, if you're in a 35% tax bracket on 250 grand, you're saving roughly $85,000 in taxes that year. It's crazy, right?
Yep.
This is fully legal, by the way. So when you think about all the different ways that we can invest in real estate, when you think about the fact that we can apply unearned losses in real estate against our earned income, and we have this opportunity to leverage cost segregation and bonus depreciation, like there is literally no better way to build wealth as a real estate agent than doing this. Not literally, I shouldn't say this. It's difficult to find a better way to build wealth than doing this. Especially when you figure like real estate, generally speaking, it goes up over the long term. I mean, it can take a dump for a couple of years like the Great Recession, but every single house in the Great Recession is worth more today than it was before the Great Recession. Like, it's funny. So it's funny. So you take this cost segregation, you take this bonus depreciation. Well, if you sell the property, I should asterisk here. If you sell that real estate and you took that depreciation early and you sold the real estate for more than what you depreciated it to, you owe the government that money back, right? Because they gave you a tax break on something that turns out wasn't depreciating. It's kind of a big game, right? They call that depreciation recapture tax. Now, the first thing you need to know is that you pay depreciation recapture tax at 25%. But you're probably taking a 35% tax break, so you're still kind of making money. But nobody wants to come out of pocket and pay the government back. Plus, I believe you should never sell real estate, right? Because it just keeps going up. The fun thing is when you die, the depreciation is wiped clean and the capital gains are wiped clean. So whoever inherits the asset now has this asset at whatever it's worth, and they don't have to pay capital gains tax, and they don't have to pay depreciation recapture tax. That's crazy. So I figured this out. And I was telling my accountant, I was like, I just want to make sure I get this straight. If I buy real estate, I can depreciate the shit out of it. I don't have to sell it, and then my kids can get this. They don't pay capital gains off of what I bought it for, and the depreciation is reset, and they don't inherit depreciation with capture tax. He goes, that's right. He goes, Peter, this is your strategy. Buy, die.
Buy more. And then,
That's literally it. So this is why real estate people love to buy more real estate.
I do have a question though.
Yeah.
So like, if you look at it, obviously the real estate goes towards your assets. So let's just put two houses, like almost apples to apples. Would you pay $100,000 cash for a house, or should you finance $100,000?
Great question. You all hear that? Chrissy's question was, if you've got a $100,000 house and you've got the cash, should you pay cash for it or should you finance part of it? This would be a great debate. You got an answer. What's your answer? Finance it.
only if you're gonna use to buy another
It
house.
depends on your comfort level with your return on your investment.
Okay, so you're,
Finance.
well, hang on, let's qualify. What do you mean when you say that, Les?
It depends on your comfort level
Huh?
with your return on your investment, your ROI.
Because the more money you put down, the stronger the cash flow.
Yes, it reduces your risk, but all cash, you're gonna have a lower ROI opposed to just whatever down payment. So, it's the best of both worlds. It depends on your risk level. If you're at my age, thank you again, but earlier, you want something that is going to be higher than sitting in the bank account.
Right.
But if you're looking to go gangbusters and get that 25 to 40%, leveraging someone else's money is key.
So I would take that $100,000 and try to buy 5 properties with it,
Or for 25%.
or
Yeah, probably
whatever
4.
it is that is your down payment, and leverage everything. As long as bare minimum, you're covering the rent and property tax and insurance, because the depreciation, the tax write-off, you're not just gaining not paying taxes, but you're gaining so many other
You're gaining
financial
additional
sections
Mhm.
that qualify you for so much.
But you got to think about the intangible part. Are you capable of managing 5 properties right now? For someone new, slow and steady. Your goal should be buying exactly what they said, a property a year. Buy that 5 over a year. And again, first one cash, the other one is finance, because you learn. But you buy 5 properties, leveraging out, and you don't know what the hell you're doing, you'll be in bankruptcy.
So like,
So what
That's
you
true.
do.
Let's get some more opinions.
I'm sorry.
No, that's good. I like it. Who else has an opinion on this?
but like that, in that scenario with $100,000, you would put $25,000 down, right?
Yeah, I think that's what
To finance it.
could be.
If you rapid depreciated that, you would get your $25,000 back. So then you're really getting your $25,000 plus you still have $75,000
That's a great
to buy
point.
more property.
And so that was kind of my point, is I have clients that ask that, so
Yeah.
that's why I was kind of asking, because I'm like, well, it depends also, and so like, I was kind of wondering, with that being said, even if you were to take like that $100,000 cash, if you were to set 75 in an interest-bearing account and then put the 25 down and finance the rest, like, you're gaining interest on money, but you can write off more.
Yes. Chad brings a good point. So if you pay one at $100,000, you can depreciate against that $100,000. If you're doing cost segregation, bonus depreciation. But if you do that money and you buy 4 of them, now you have $400,000 worth of assets to cost segregate, depreciate. So you could get your entire
$100,000.
$100,000 back in tax benefits, or close to it. You also don't have to do 25% down. Like, there's some people that house hack on like an FHA and they'll occupy it for like 3.5% down, and that's great. I personally prefer putting 30 or 35% down just because I like cash flow. So it just feels better when the cash flow is there in case my tenant leaves for a little bit. But the other thing about borrowing money is that they can take advantage of interest payment, right? And have the interest be an expense against their income. So there's also some value there. Great question. Anyone else have ideas on 1 property to 100 or 4 at 100? No?
I would just say, you have an investment portfolio that is outpacing what the mortgage rate is. So say, over the last century, stock market overall is about 10% return per year.
Yep.
So if you're paying 5% interest or 6% interest rate, that you could write off. 10%.
Yeah.
Investment portfolio, you probably want to finance it and put the rest of it.
That's a great point. That's a great point too. 100%. Nice. What else? All right, so second half of your sheet, there is a, it says 5 boxes on the left and 3 on the right. I want you guys to write down 5 takeaways or things that you could do to move the needle in your finances. This is the part where you get out your pen and start writing. Your pen? Very much. I love it. I think we're not chatting. Are there any more of those papers?
Lindsay took.
I think Lindsay. Oh, we're good, Jim.
There you go.
Shameless plug here.
Yeah.
So I'm gonna teach property share next.
Oh, that's a great one. Yeah.
So if you would like to make some money without any financial investment. Profit share next Tuesday after the meeting.
That's great.
If you have no money, you can still make money.
That's true. That's true. It works. It's a beautiful thing.
So you essentially want to get to the point of real estate where your purchases are negating with your personal income tax as far as real estate.
What you think that? Yeah.
Really, yeah.
That's crazy. All right, so does everybody have their 5? Does everybody have their 5? We're not done yet. Yes, Peter, I have my 5.
Yes, Peter, I have my 5.
Okay,
5-0.
thank you, Christy. Now, there's no way you guys can do all 5 of those things. I know this to be true. So I want you to pick 3 right now and put them on the right-hand column. Things you're going to do before Sunday. Ready, go. Before Sunday. Otherwise, it's not going to happen. I know you, realtors. I see you. I am you.
Peter, thanks for your time.
My pleasure. Thanks for coming, Chad. Don't think about it. Just do the easiest ones. Okay, everybody have their three?
Yes.
You have a question? Christopher wants to know what?
If you have cryptocurrency number, cryptocurrency.
Am I?
Are you allowed that?
Do I love it? I don't, because I don't really understand it.
Or Kurt?
What's that?
We need Kurt.
All right, Doug. Yeah. Tell us about the ALC. How did all this happen today, by the way,
Yeah,
Doug?
so for those of you not familiar, I'm on the ALC. So with Keller Williams, each office has what's called an ALC, which is the Associate Leadership Council. We're basically a board of directors, and we have myself, which is finance, Chad Foreman, Jim Pope, Sarah. We're all growth, education, culture, and so I'm on finance. So I asked Peter to come because usually when he teaches his class at the board for CE, it gets sold out. So I know it's a popular topic. Kind of as Peter alluded, school, no one really teaches wealth to us in college or school. So I thought it was a pertinent topic. So yeah, if you are interested in being on the ALC, I'm on the finance committee. We all have different chairs. So reach out to one of us so we can get more awesome speakers like Peter. So,
Thank you, Doug.
yeah.
Yeah, that's awesome. Thanks, dude.
Thanks, guys.
Appreciate it. Okay, questions, comments, thoughts, concerns, ahas. What's going through your head? Yes.
Okay, for number one, that was a lot of information.
Yes.
And then there's just so many, like, just even the insurance and all that. Like, how do you know? 'Cause there's so many options. So there should be, like, with all of that, you're like a central person that helps you with disability insurance. I mean, all the things.
Yeah. So the insurance representatives that we all know are like, did y'all get the question?
Yeah.
So the insurance people that we all know are like property and casualty insurance, like State Farm and that kind of stuff. There's a whole other world of insurance people that do life insurance, disability, that kind of sort of next tier financial insurance. You can ask your property and casualty person who they recommend, who they would refer. I would strongly suggest you talk to 2 or 3 people before you pick one to start doing all that planning, because that world can be a little snaky. Does that answer your question?
It's just, yeah, it's just a lot. And it's
It's
like,
a
you
lot.
want to do it like, immediately right now. And I
Do or do
possibly
not.
could,
Yeah.
but I don't know. It's like, well,
Just-
I'd get criminals.
So then your task before the end of Friday is to get 3 different referrals for someone who talked about disability insurance.
Okay.
There you go.
That's what my son does.
Perfect. You better not mess with mom's friends, so.
He sends me referrals, I send him referrals.
That's awesome. Other questions? What's going through your head? What are the ahas here?
I didn't think, honestly, I did not think about using the HSAs and the disability as like additional assets. I was just like, oh, that's money that I don't want to spend right now, instead of actually thinking of it as an investment. So
I love that.
I like it.
Nice. That's excellent.
Will you have a class just for wholesale? Because I don't know about what else in the room. I'm getting calls personally when to buy my property. I'm getting calls from people who want to look at 100 houses that today to find the right house. And I would like to get in that business and and just see how that works, especially how you create the model and put it inside an LLC.
Yes.
And I have an idea how to start. I just don't have a framework
Yeah.
to work on it.
Does anybody here do wholesaling? Yeah? Gentleman behind you does. Can you guys connect afterwards? That'd be great. What else? Yeah, Judy.
So I have recently been talking with a financial planner and working on these things, and
That's awesome.
with getting life insurance, I was recently told that since I'm an employee of my LLC, they can write off some of the
Benefit?
the premium or
Yeah.
whatever you pay. Have you heard of that or know of that?
Yeah. I mean, I've paid my health insurance for my company for years, 100%. Talk to your accountant.
Yeah. Well, I mean, yeah.
Yep.
But I thought
100%.
that was interesting.
Yeah.
I've never heard that.
Once you have this S corp, like so many different tax advantages. kind of open for you. That's exactly right. Yeah, great,
I can also-
great observation.
They said they had my husband as an employee, and paid his through the same way.
As long as you can prove it,
Sure.
you've got to do something.
He does. He puts some
Besides make
things
you
out,
happy.
Does things.
Okay,
Yeah,
all right.
sure.
Did you say life insurance?
Yes.
Okay.
Same with your children. Right. It's paid out.
Yeah, if you open their names and they'll see it.
Yeah, a lot of, so a tax strategy is sometimes realtors will hire their kids. What's the SEP IRA, sorry, what is the Roth IRA maximum per individual right now?
I think it's 5,000.
I thought it was closer to 8,000. So a lot of realtors will hire their kids for $8,000 a year to do like realtor admin. And then their kids can take that money and you can put it in a Roth IRA. So they can start growing tax-free for 70 years or 60 years until they retire. That's pretty powerful.
And they actually should put 20,000 into their in their kids because they don't pay taxes on the first 20,000, as well as since they're your dependent, it has to be a dependent child. You do not pay any employment taxes
Right.
or anything out there. So that's literally great financial wealth.
Yep.
And then it's not simply just doing the Roth IRA, it's also doing a traditional for them, a custodial IRA once they turn 18, they get full control over it, but still that's ways to keep money
Yeah.
from Uncle Sam and into the family's pocket.
I love that. Anything else, guys? No? All right. Well, thanks for coming, everyone. Appreciate it.
That's very helpful. Thank you.
Yeah, my pleasure.
Right down.
That's all I.